When you look at Google, we're concerned about margins, we're concerned about not their growth model, but how much money they can make going forward. Is it that Wall Street inflated our expectations, or is that actually we have questions about the model?
I think there are questions. I think Google right now is very much of a cost-cutting business on their moonshot business. I think everyone knows that search engine revenue is plateauing. It's a market that's hitting saturation. This has been inevitable for the last few years. And as the world switches over to mobile, consumption of search goes up, but the value of the clicks actually goes quite down. That's reflected in the earnings. And Google's been spending its big cash hoard, spending money on investing in basically new projects that could actually generate revenue.
But Hussein, this is a winner-take-all, or is it? And actually, if it is winner-take-all, Google's number one.
Google's number one in search, but I think it's a winner-take-all. That was a winner-take-all in last year's market. The question is, who's a winner-take-all in next year's market or the next decade's market? You know, it looks like the dark horse has been Amazon with its cloud computing platform, which is both a threat to Google as well as to Microsoft. Microsoft's a very distant third. Google is built up into kind of a number two, but still nowhere near. Sorry, Google's the number three. Microsoft's the number two, but it's still nowhere close to where Amazon is.
Let's look at where these have come since the Lehman lows back in '09, early '09. Apple, obviously, a major performer, and I don't really want to compare Apple directly. And here's Google and Microsoft. The yellow line is Google, and the orange line is Microsoft, with finally Microsoft getting their act together. Hussein, are these blue chip stocks masquerading as tech companies?
No, I think these are still very much tech companies, you know, and there's a lot of innovation that has to happen in order for them to become big. The big question is, I think Apple called the mobile revolution correctly. It built the iPhone and then capitalized on that. Microsoft completely pretty much missed it and was very reluctant to switch to a lower margin business. And Google played defensive and did the Android business and has been trying to catch up. But you know, once you win and you become, it is a winner-take-all market in this world. And Apple was the first one and kind of got first mover advantage.
They've got first mover advantage, okay, but what's Microsoft's new plan besides Xbox, whatever, has gone away this week? I mean, where do you see Microsoft in 3 years or 5 years?
So Microsoft, I mean, they've replaced their CEO, right? They have a new person at the helm, and what Satya is trying very hard to do is shift the market over to a cloud-oriented business, and that's been kind of the mission. It's very clear that that's the future of the business. The mobile business has pretty much been a disaster. The Nokia acquisition wasn't particularly good. Lumia sales are down something like 73%. That's not interesting. The PC market, which is Microsoft's historic strength, is going down. I mean, you've seen the battle. You've seen kind of the woes that Intel is facing because Intel also made the wrong kind of call on that. Microsoft is now trying very hard to play catch-up and try and win in the cloud business. You know, it's doing a good job with Azure, but it's still very distant compared to Amazon. You know, Microsoft lumps all of their businesses together in the cloud together, and as a result, it's hard to tease out exactly how Azure is doing. You know, last quarter they were at a $9.4 billion run rate. Yep. You know, now they're at a $10 billion run rate. It's not as much growth as what the street is expecting.
Larry, how does this translate into your world, right? We talk about these on a corporate level earnings, but actually these are huge companies that make a lot of money, don't really spend that much cash, and employ very few people.
Right. So there's obviously a political element to this. These are some of the biggest cash-holding companies in the S&P 500. There are a lot of, obviously, concerns about not using that cash, keeping it offshore for tax reasons. That has been politicized, as we know. Ultimately, though, they are essential to long-term productivity growth. Productivity growth is very much linked to the technologies that we're talking about. And some may be a little bit more aging. Microsoft struggling to catch up. Others are clearly now beginning to revolutionize retail. Think of Amazon and what it's doing to big box retailers.
Do governments around the world, when you measure productivity, do they need to look at these big tech companies more to try and I guess, change their models?
I think there's a tendency here to look a little bit at the present and extrapolate to the future. The reality is, and we've just heard it, is that it's a very dynamic process of winner-take-all in many of these types of markets. And today's winners may not be tomorrow's winners. So, as it were, trying to focus, let's say, technological revolution productivity on the basis of who's on top today could actually be pretty misguided. I don't think the government really has a role there to direct that kind of investment.
Larry, I mentioned blue chips earlier. Is a general statement, is it a time to capture coupon, dividend growth, share buyback, or can you be more growthy going into 2017?
Well, when we look at the market these days, what we see is a bit of a disconnect. Cyclicals seem to be underperforming right now relative to some of these growthy areas. That's true as risk premium have fallen over the last 2 months. So actually, our preference now is to actually look for where there are modest earnings surprises and things that are a little bit more cyclical. The relative valuations are preferable. I must say that's a fairly short-term and tactical view. Over time, obviously, latching yourself onto some of these exciting growth opportunities is certainly going to be part of anyone's core portfolio.
Where do you look at the banks? I mean, it's sort of been our theme for the day. Again, folks, I go back to Francine's interview with Michael Fuchs about the joys of Germany. Are the banks viable here, or is there just so much uncertainty you need to wait for more information?
Well, viability raises the question of sort of sustainability. I think from that perspective, banks will be viable. They're making enough, as it were, to attract capital. Their ROEs are sort of at those threshold type levels. But if the real question is whether bank shares are actually preferable at this juncture, I'd say no. We're again looking at things that are slightly more cyclical, looking at some opportunities where there's dividend growth possibility, where there's strong cash flow and relatively low payouts. So that's largely outside of financials.
And actually, Hussein, when you look at a lot of these tech companies, they're in stark contrast with the banks because they attract capital, and people keep on asking themselves, well, are they overvalued? Do you need to look at it company by company, or is the industry as a whole just propped up too much?
No, I don't think it's industry. I don't think it's industry-wide, because if you look at a lot of the companies that have missed a transition, I think their stocks have come quite down, and there's not a lot of capital chasing those companies. Unfortunately, the companies that have figured out the growth engines and have predicted the future correctly, a lot of capital, especially in this market where risk premium are very down, is floating towards those because, and it's a supply-demand market. This is a market I don't think that's as driven by fundamentals today as it is by kind of supply-demand characteristics. The good companies attract capital, and this is happening in the private markets even in an even more inflated way.
Hussein, thank you so much. Hussein Kanji with us this morning.